Hello everyone, today with MarketXLS we're going to talk about the long call option strategy. MarketXLS is one of the top Excel-based investment research solution for investors. In this video we'll be learning what a long call option strategy is, how it works, when to use this strategy, the possible range of return, and finally we'll understand how MarketXLS can help investors to implement this strategy. So without any further ado, let's start with the discussion. This strategy is implemented when the trader has a positive outlook of the market or the stock. Long call is used when the trader has a bullish view of the stock market. The closer the strike will be to the current price, the better gain the trader will get if the view proves out to be true. A long call option strategy can be implemented by buying a call option and expecting the price of the underlying stock to go up. The maximum loss that can be expected is the net debit of the strategy. The net debit means the net cash outflow, which is equal to the premium of the call option the trader paid. So in short, the maximum loss would be limited to the premium paid. The maximum profit can be unlimited if the stock price continues to rise. MarketXLS offers a template for this strategy. Here's an introduction page and here's the active template. The cells in yellow have to be inputted by the user. So the stock ticker, expiry date, strike price, and the plot gap. The plot gap is same as the spread. It is the difference between the lower and the higher strike price of the two call options. Some upcoming expiry dates, the current share price, and the lot size are available for the investor's reference to the right. For the purpose of this video, we'll be using Apple as the stock ticker, expiry date as 19 February, and we'll be buying one lot of call option at 135 strike price. The net cash flow would always come out as negative since the investor is buying the call option and hence there will be an outflow in the form of premium. In this case, the net cash flow is $185, which is the result obtained when we multiply the number of units with the premium paid and the lot size. MarketXLS has many templates just like the long call one you see here, and it refreshes all the data when you click on Refresh All. MarketXLS offers a net payoff table and a net payoff diagram to help the user observe the potential profit or loss at different expiry levels. The table contains the net payoff of the strategy at different expiry prices. In the chart, the y-axis is the net payoff of strategy, and the x-axis is the range of expiry prices. Maximum loss occurs when the stock price moves in the downward direction. Maximum loss is the premium paid by the trader. Maximum profits are unlimited when the stock price continuously moves in an upward direction. That is all for today. We hope we were able to help you understand how to use MarketXLS for the long call option strategy. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.